Welcome back. Today is Tuesday, August 18th, 2026, and we just saw one of the largest single-day options block trades of the entire summer hit the tape. A single institutional player dropped over $129 million in cash on November deep-in-the-money put options on the 129M Semiconductor ETF, right as the broader market coils just beneath all-time highs. This massive downside bet landed on the exact same morning that Bank of America released its August Global Fund Manager Survey, showing cash levels plunging to a 5-year low of just 3.5%, and equity exposure jumping to 56% net overweight. We are witnessing a stark collision between euphoric retail and institutional positioning on one side, and surging capital costs, rising bond yields, and physical power constraints on the other. Today, we break down what this whale trade means, what the credit markets are signaling, and how smart money is repositioning ahead of Nvidia earnings next week. Let's look at the exact mechanics of this $129 million trade. On Monday morning, around 11 a.m. Eastern, 20,100 contracts of the SMH November 20th 630 puts were bought in a single block at an average premium of $89.75. With SMH trading around $594, these puts were already deep in the money, representing an enormous delta exposure. When an institution executes a block of this magnitude, it generally means one of two things. Either a massive fund is taking an outright synthetic short stance against semiconductor leadership, or a mega-cap tech holding is locking in downside insurance ahead of Nvidia's quarterly report. Either way, spending $129 million in straight option premium indicates that someone with serious institutional capital is unwilling to walk into September unhedged. That options trade makes even more sense when you look at the findings from Bank of America's August Global Fund Manager Survey. Chief strategist Michael Hartnett and his team polled 203 institutional managers, overseeing nearly $600 billion in assets. The headline numbers are eye-opening. Average cash allocations dropped to 3.5%, marking the sixth lowest cash reading in the 28-year history of the survey. Meanwhile, net equity exposure surged to 56% overweight, the highest level since November 2021. The survey's bull and bear indicator jumped to 9.3, pushing well past the standard threshold that historically triggers a contrarian sell signal. The core message from Hartnett is that market consensus has become dangerously uniform. Over 56% of institutional managers now expect a pure no-landing economic scenario where growth stays resilient despite high interest rates. Long global semiconductors remains the single most crowded trade in the world, with roughly 70% of respondents confident that AI capital expenditures will not face any cuts this year. Because cash buffers have fallen below 4%, Bank of America's cash rule has officially tricked. Hartnett's advice to institutional clients is clear. With positioning priced for perfection, investors should be rotating within risk assets and taking profits rather than aggressively reloading. While equity investors stay bullish, the credit markets are sending a very different signal about the real cost of funding AI infrastructure. On Tuesday, Blackstone-owned data center provider QTS completed a $3.9 billion investment-grade bond offering, codenamed Project Odyssey, to fund Microsoft's massive data center campus in Georgia. The offering attracted massive demand, with over $23 billion in orders, nearly 6 times the deal size. But despite that intense demand, the final yield priced at 7.228%, compressing just 40 basis points from initial guidance. For an investment-grade debt structure backed by top-tier tech leases, paying over 7.2% looks uncomfortably close to junk bond pricing, proving that the cost of capital for AI infrastructure is repricing rapidly higher. Financing isn't the only bottleneck tightening around the AI build-out. The physical electrical grid is reaching its limit. PJM Interconnection, the regional transmission organization managing the largest power grid in the United States, formally filed a new regulatory proposal with FERC called the Interim Resource Adequacy Service. Under the proposed rules, any new large load over 50 megawatts connecting after June 2027 must effectively bring its own qualifying power generation or battery storage. If they don't, PJM will mandate that these data centers run on-site backup generators or face automatic power curtailment during grid stress periods before residential customers are affected. This regulatory shift puts massive capital pressure on hyperscalers, while triggering a reassessment of independent power producers like Vistra and Constellation Energy. All of this massive capital demand is spilling directly into sovereign debt markets. The 30-year U.S. Treasury yield climbed to 5.31%, holding near its highest level since 2007, while the 10-year yield pushed up to 4.75%. It is not just an American phenomenon. 30-year UK gilts are trading near 1998 levels, and German 30-year bunds are at 2011 highs. With between $2 and $3 trillion in global capital actively competing for AI data center builds, utility expansion, and sovereign deficits over the past 18 months, the long end of the global yield curve is demanding a substantial term premium. When risk-free yields offer over 5.3% for 3 decades, equity valuations have zero room for execution mistakes. Looking beneath the hood of the bond market, systematic trend followers are leaning heavily into the sell-off. UBS flow data reveals that commodity trading advisors and trend-following quantitative funds have tripled their short positions on global bonds, reaching historic record short exposure. In fact, every single basis point move in the 10-year Treasury yield now drives roughly $300 million in profit and loss swings across these CTA accounts. Meanwhile, the yield curve is executing a classic bull steepening move. Short-term 2-year yields are grinding lower as the market anticipates eventual economic cooling, while the 30-year yield remains stubbornly high. This steepening spread signals that long-term funding pressure, rather than runaway near-term inflation, is driving the bond market. With macro pressures building, technical price levels in the semiconductor sector become critical reference points ahead of Nvidia's earnings report next week. For Nvidia, the $212 to $213 zone represents a major confluence of its 20-day moving average and prior breakout resistance. If Nvidia pulls back ahead of the print, this area represents the first critical floor for bulls to defend, with secondary support resting near $195. For AMD, the stock has shown relative technical weakness beneath its 50-day moving average, with market technician Brian Shannon highlighting the $440 level as the key anchor off its year-to-date low. As long as these primary support lines hold, the structural trend remains intact, but any break below would confirm the warning from that $129 million put whale. As semiconductor leadership experiences turbulence, capital is quietly finding an unexpected defensive shelter in Apple. Over the past 40 trading sessions, Apple's correlation with the Philadelphia Semiconductor Index dropped into negative territory, marking the lowest correlation between Apple and chip stocks since 1994. While soaring high-bandwidth memory component prices pinch hardware margins across consumer electronics, Apple's massive share buyback program and rock-solid balance sheet make it an ideal defensive rotation vehicle when AI infrastructure trades pull back. With the annual September iPhone hardware event just weeks away, institutional desks are treating Apple as an effective hedge against broader chip sector volatility. Recent second quarter 13F filings confirm that super investors are executing significant rotations of their own. Warren Buffett's Berkshire Hathaway ended a 3.5-year, 14-quarter selling streak, becoming a net buyer with $23.5 billion in stock purchases. The standout move was an 83% increase in Berkshire's Alphabet position, bringing its holding to roughly 106 million shares. Meanwhile, Bill Ackman's Pershing Square executed a major portfolio reshuffle, initiating brand-new positions in Visa, MasterCard, S&P Global, and Netflix. Value investor Li Lu also made waves by more than doubling his position in PDD to over 22% of his total portfolio, demonstrating high conviction in consumer platforms. Beyond mega-cap technology, we are seeing sharp divergences across consumer and logistics platforms. Uber has completed a historic business transformation, transitioning from burning over $40 billion in venture capital since inception to delivering robust free cash flow, with Wall Street forecasting up to 45% annual growth as it aggregates rides, delivery, and autonomous vehicle fleets. In contrast, Nike continues to languish near 12-year valuation lows, around $40 share, following cautious guidance from European peer On Running, illustrating how selective consumer discretionary spending has become. Putting the entire picture together, today's market sends a clear message for portfolio risk management. When global fund manager cash drops to a 5-year low of 3.5%, equity allocations reach 56% overweight, and a $129 million put whale appears on the tape, complacency is at an extreme. As long-term Treasury yields hold above 5.3% and AI data center debt commands 7.2% yields, the margin for error in high multiple growth stocks is razor thin. The playbook here is disciplined. Respect the technical support anchors at Nvidia 212 and AMD 440, watch for CTA short squeezes in bonds, and balance high-flying AI beta with cash flow compounders and defensive hedges. Stay nimble, protect your capital, and we will see you tomorrow.